We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cash Flow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of Cash Flow Pro, your daily real estate investing podcast and YouTube channel. I am here today with Nate Scott of Living Wealth. And we had an episode not long ago where we discussed this concept of infinite banking. Okay. The infinite banking concept was pretty deep, and I don't know that we were all that well situated to get to be able to get a full grasp on just how the brevity of the topic. Okay. So what we're going to do today is we're going to cover with Nate some of the basics again. So some of it's going to be repeat, but the majority we're hoping is going to be new stuff, and we're hoping to try to take some of the pieces that we got before and plug these things together. So Nate, welcome to the show.
Well, wow, Casey, thank you for having me on. This is exciting. I'm number
Absolutely.
two. I'm happy to be number two in the infinite banking world and see if I can add or fill in the gaps for what your audience may have missed on the previous one.
Yeah. And that's, and again, and Nate and I were talking pre-show and you know, I told him that I tend to, my audience, the listeners, I feel like when I have a gap, I feel like that gap probably goes into the same spot in the listener's mind. And what happened in that particular episode was then I got the feedback from the listeners, and most certainly there was questions, the exact questions I had. And again, that's been a couple of months ago, so I don't necessarily remember exactly what those were. So I'm going to let you fill in and start, Nate, by telling us first thing we want to hear is who you are, where you come from, and what your story is, and how you got started doing what you do now.
Yeah, so we're just outside of Kansas City, Kansas, on the
Okay.
Kansas borders where we're headquartered. Living Wealth is. I'm actually a third generation into the family business. Essentially, my grandfather-in-law started, so I actually married his oldest granddaughter. So I'm not blood, but I guess I count as third generation to some degree. And he was introduced to this infinite banking concept back in 2001. So we've essentially he'd been in the financial arena doing regular retirement programs, pensions, and all sorts of different things prior to that. But we as a firm have been here for 21 years, really focused on all we've done is infinite banking. We've gotten rid of all of the typical financial planning style stuff. And that's really where I fit in. I got here in 2012, so I've been in it with him for 10 years, practicing infinite banking myself, but also doing it professionally. Sure. I really do believe that the solution it provides is very desperately wanted and needed by most people. But as you bring up, it's not the simplest thing to talk about. I wish it was a lot simpler to talk about. I wish it was kind of a set it, forget it style idea. Where that would make my life a lot easier, and that would probably make every listener's life a lot easier if we could just say, bada bing, bada bang, bada bong, here we go, and
here's all the money you need.
Exactly right. It's a get rich quick scheme. It almost sounds schemy, and I want to maybe stress that it's actually not. It really is not. And I know, of course, the guy who's selling the snake oil may say that. I'm saying it's actually not. It makes a lot of sense, and it fits really perfectly for certain people's objectives. But it is possible that your objectives are not actually looking for this type of solution. So we want to lay that out there, but the solution itself works the way it's supposed to work, and offers what it's supposed to offer, especially to a certain group of people. I think it can help everybody, but certainly we can talk about that later too, of like how it helps. And essentially the one thing I like to say, and I'll get it out of the way, infinite banking, this process of becoming your own banker using whole life insurance really can help everybody. The question is the scale they want it to be, if that makes sense. So everybody has bank accounts. Obviously, it's impossible to survive without one. And infinite banking is really a way in, and it's probably not the only way, but it is a good way, and it's the best way I know of. And I don't plan to say I know everything, but it's the best way I know, and I know it works, having done it for 10 years. It's the best way that we know of to become more profitable in what we call the banking arena, and which is different than the investment arena. So I think most of your listeners probably make a lot of money by taking money out of the banking arena and putting it in the investment arena. That's actually kind of their goal in life, right? We don't want a lot of money in the banking arena. We want to pull it out and move it in the investment arena so it can actually make a return. What we're trying to solve is, well, what if there actually is a way to make money in the banking arena? What if that's actually possible? That the banking arena, what I'm referring to that is the flow of money. In other words, that it's not
making money for the consumer though, rather than the institution.
We all know banks make a ton of money on our money, and they do not share it with us. So this is a truth.
You know, my dad, my stepdad actually used to say, there's a reason banks got marble floors and we've got wood.
Yeah, they got all the money. We're the one who gave it to them too. We know it's an incredibly profitable business. There's just no feasible way for the average person to get into the banking world. In other words, to create a real bank is a very profitable business model. It takes a whole bunch of money. You got to raise a whole bunch of money, and it's a super arduous endeavor. And the barrier to entry is very high. So most people are saying, I don't want to be an entrepreneur. Excuse me, I don't want to be an entrepreneur starting a new bank, though I see that's very profitable. Is there another way for a little old me to plug in and make money kind of like a bank makes money, which right now is not possible in the banking world itself, especially with deposit accounts paying essentially zero. You can't do it. So the only solution is let's take money out of the banking arena, put it in the investment arena, hope to earn return there, because the banking arena doesn't make money for me. This is actually what infinite banking is trying to solve. And so I'm trying to say it's actually not weird. It's just saying, are there other tools that exist that we can treat kind of like a bank that just makes us more money doing the same things we're already doing? Now, I think your listeners may have a whole bunch of questions like, okay, well, how does the life insurance policy fix that hole? We could talk as much as we want about that, but that's what we're trying to solve. We're also not trying to tell people that they should, instead of making investments, put money in these banking policies. That's actually not what we're saying.
That's right.
So we're not trying to convince somebody that the rate of return inside of a life insurance policy is greater than the rate of return they get to receive elsewhere. That's not what we're trying to solve. We're just trying to solve a different way for money to essentially move. In other words, instead of building up money in a bank account and then finding a deal to put that money to work in, and then that deal may pay out some cash flow, it may pay out some some refinancing, especially like in the syndicate world, and then so you'll get maybe 5 years from now, you'll get a huge big check back plus all the cash flow in the interim. And essentially we don't like having it sit in the bank world because it's just wasting money. So we have to go find the next deal. But what we're trying to say is there's actually a way to have that money make money for you too. And I know that sounds kind of good, but it's not. That's just what it is. Yeah. Okay. Essentially.
All right. So
go ahead.
So let's start at step one of this process and say, I have $50,000. I have $50,000.
Yeah, you have $50,000.
What do I do with it?
Yeah, exactly right. So this actually goes back to the scale question, Casey. So in other words, everybody should do, I believe, should practice this concept in some way. The question is scale. So whenever I talk to somebody, I don't know how deep you want to get it, but let's go back to your example, and then we can flesh it out in as many different ways as you want, as much time as we have. So, but let's say you have $50,000. We would take a look, and you would come to me saying, Nate, I have $50,000. My question to you would be, okay, what is your objective for this money? This is where we would start. You could say, is this your emergency fund money? Is this money that you like to keep on the side because if all hell breaks loose, you would like to be able to have some liquid money that's not tied into an asset? That would okay. My recommendation to you in that world would maybe be different than if you came to me and said, I've got $50,000, but I am looking to put that to work someplace, like let's say in the real estate world, or I'm looking to make an investment with this. And so what I'm saying is there's a few different tracks, there's a few different scales you could possibly go down to determine my recommendation based on really what your objective is for the money you're essentially telling me you have, right? So,
Okay.
but
Yep.
with that being said, I actually ran a scenario for a real estate group. It was a couple of years ago, and they were it was a real estate kind of coaching group, really. So they had a guy who was kind of the head coach, and he was teaching people how to find opportunities, mainly in like small commercial properties, like fourplexes and eightplexes, and 4 unit style
Okay.
deals, and
Sure.
and he would teach them how to find the deal, how to rehab it, and it was all a thing. And so he asked me to come on for their investor group, and they would try to put in $50,000 to buy a $500,000 small fourplex. As I said, this might be dating,
Okay.
by the way. You can't really it's like you can't really find that right now, but all this is probably like
Yeah.
2016, 2017. I don't know. It was a few years ago, and I just bring this up to say the idea was we have people who are going to build up 50 grand in a bank account that they need to build this up. Maybe they already have it. Maybe they're trying to get there so they can make an investment in something. And so they're trying to build up this
Okay.
cash to be able to do it. And what we're trying to figure out is, does it make sense to fund this investment with a bank account having 50 grand, or would it have been better to move the 50 grand into a policy and fund the investment from the policy? This is essentially the question we're trying
There you
to
go.
figure out, right? So why would it
Okay.
make sense for somebody to consider taking cash from the conventional banking world, using it, moving into one of these specific types of policies, which, by the way, we haven't even really talked much about. I'm kind of leaning on the fact that you just had a guy talk about some of the basics, Casey, but I can move
Yep.
back and talk about the
Yep.
basics too, if need be.
Well,
But
we want to we want to plug in, and I'm making notes here so that we can go back and rehash each spot as we're going to start. We're going to go to the next point, then we're going to go back, go over those, then we're going to go back and go over and add. We're going to add to this here so that we can figure
okay.
out the process. My folks are process driven people that we want to be able to provide value to. So
Okay, good.
we have to nail this down in a process and say that's why I started with 50,000, and how do we make that work, or at least give us the beginnings of how that looks for an infinite banking setup. So
Yeah.
far
Okay.
I've got the money, and I've got determine what you desire, what your determine use you desire with the money, whether it's like you said, whether it's emergency fund, or whether it's something that, hey, this is additional income that my wife and I got an inheritance, or something that is just sitting out there that I want to make sure I put to work so that I'm not wasting, and so on and so on.
Yeah, you're right. So if we want to take a step back, maybe that I can kind of play out the idea of putting
Yeah.
of objective. I can flesh out all of this essentially each individual. So there is value
Yep.
in a policy itself, Casey. So the policies that are
Okay.
used to practice infinite banking, they grow guaranteed. They're guaranteed to increase every single year. They earn dividends based on the profitability of the company. Most of the companies we would recommend are these things called mutual companies, and they've been around since the mid 1800s, the vast majority of them, some of the oldest
Okay.
companies we have. And they pay dividends every single year
Okay.
since the mid 1800s. So it is based on profitability. They're just very
Okay.
profitable. So I'm saying the asset itself is actually quite valuable in a lot of ways. So as you brought up, there's a and it's all of it's very liquid, so we can use 100% of the cash value in existence anytime. There's no rules or limits, and it's always can be used on a tax-free basis. So there's a lot of value, and we could dive into each of those if we want in the asset itself. But as you brought up, the infinite
Okay.
banking is less, and I know maybe people don't like to hear it. It's actually less about the product itself, and it is more about the process that you will implement when you own the product, if that makes sense. So that's really what the
Okay.
infinite bank concept is. We understand that a whole life insurance policy has some value that some people may really enjoy having, but that's not actually infinite banking. Infinite banking is not equated with whole life insurance, uh, specifically high cash value life insurance built for this purpose. That is simply a means to an end. The end is I want to become profitable in the banking arena, right? So that may lead us back
Okay.
to the example that I built, or that I'll lean on potentially for that was mentioned in the investment group, which kind of said the same thing. Like, hey, we think that really the minimum to get into this is $50,000, and so these people are going to be building up this money anyway. Maybe they've already got it. Maybe they're saving up to get there. But even in like a syndication world, most of them have minimum investment requirements. I don't know if maybe your audience can get past that based on how you operate, Casey, but a lot of times it takes money, right? Like, go ahead.
Yeah, that's right. I mean, 50,000 is in all respects, 50,000 is kind of well, it's our minimum for our
Yeah.
fund that we've got.
It's hard to find
And
one less than
so
that.
again, and 50,000, yeah, it's kind of yeah, if you find one that's less than that, you again, it's risk v reward. Um you just less than that, you almost have to question the operator, because whether or not they're going to be handling tons of investor relations issues
Yeah.
rather than out looking for the next deal. So
Yeah.
you're basically looking at 5 investors per the one, and it can get pretty hairy pretty quick.
Marketing costs are
It
going
can
to weigh
become a
up for the
relational
fund,
nightmare.
and yeah, investor relations is going to
Correct.
go crazy.
Correct.
And
So you
you're
have to be
exactly
real
right. There's
careful there.
economies of
Yeah.
scale that exist for a reason. So, but with that being said, it normally takes money to get into the deal. Money's got to build up someplace. That's banking, right? Money
So
has to
yeah,
be
so that's
accumulated.
where we came. That's where I came up with the 50,000. Just because that's what, like I said, if that's a minimum investment and somebody's looking at this concept, is that a reasonable amount that could even have anything done with? Because what
Okay.
I'm trying to stay away from here is the concept that my that the listener is going to have $2 million in order, $5 million in order to make this be a reasonable way to operate. Now, obviously, the process could still be there, but we want to just see what does it take to implement this process and have this be part of their plan.
Yeah, there is no minimum amount to get started with this, Casey. We've got clients who pay a couple $100 a month
Okay,
into a policy to start. Of course, we have clients who
sure.
pay millions of dollars a year to start. There is no minimum. There's no maximum. That's what we love about it. There's no rules like in the retirement program style world. You can put as much money as you want and have all of the distributions be tax free. You put a little bit, you put a lot.
So does the policy become like a pass through
It does. That's
of
that's the
sorts?
concept. Yes, that
Okay.
it
So
fulfills
you invest.
essentially what I'm saying, Casey, is it fulfills the need not to offer you a new investment opportunity, but more to offer you a new
Okay.
idea of banking, which is mostly a flow through style. Like no one wants to have. We like having money in the bank, but no one wants to have a lot of money in the bank because
Yep.
that means you're just wasting money.
That's right.
So
Yep.
that's
That's
actually
right.
how
Because
we
it's
feel
good
about the
inflation
policies.
or yeah. So somebody puts $50,000 into a whole life insurance policy or contract, and then they turn right around and draw that money out as what?
Yes, they draw that out as typically I would recommend a policy loan if that's what you're asking.
Okay.
Is
Yeah. Is that
like
so?
how does the money get
Is
out?
that the general idea here? What's
Yes.
that?
Yeah. So there's multiple ways to get money out of it. The best way to really practice the concept is through a policy loan. So let me take you through my example
Okay.
that might actually flesh it out because I'll show you exactly what we're talking
That'd
about.
be good.
Yeah,
Yeah.
and
Let's go for it.
then we can flesh a whole bunch of the pieces out one by one once they kind of get the full picture. So in this scenario,
Okay.
what we're going to build up is we need at least $50,000 inside of a policy cash value to be able to make a down payment or an investment, depending on what group you're talking to. And so I think what we did in this policy,
Yep.
we put in about $70,000 total. So we put in a little bit more than what we
Okay.
actually needed in order to fund it. But that was just based on how the example worked. But all we wanted to do was make sure our cash value was over 50 grand. I think we were up in the upper 60s or something like that. I think we had like $67,000 of
Okay.
cash value or something of that nature. And the individual is going to pull a $50,000 policy loan to fund this deal that they're going to make, this investment opportunity. And in this guy's
Okay.
world, they were shooting for an average of about 9% cash flow. That was what they were shooting for at the
Okay.
time. Could be higher,
Okay.
could be lower.
In his deal.
Like
In
that
his
was what they
deal
were.
outside of the insurance company.
Yeah,
Okay,
and it has
cool.
nothing to do with the policy
Gotcha.
at this point, right? The policy is kind of the flow through. That's what we're trying to talk about.
Yep.
The policy is just
Yep.
it is we like to call it. We're using the policy to finance our investments, right? Now, it actually doesn't mean that you
Okay.
don't go get financing. I'm just saying, like, your portion, your down payment, we're now, instead of financing from a checking account and writing a check, We're going to build that money up
Yeah.
in a policy and then pull the money out of the policy to fund the deals. So the objective is
Okay.
still the same. Just how we paid for the deal is different. And so in this world,
Yep.
what we'll
Okay.
suggest we do is we'll pull the $50,000 out, we'll put it in the deal, and this guy was hoping to get a 9% cash flow. That's what he would say is a good deal, cash on your down payment on what you put in.
Okay.
So that's about $4,500 a year. 9% of 50,000 is $4,500 every year in positive cash flow. Obviously, paying the bank, paying all the expenses to run the operation, and then you end up with a net of $4,500 a year. That money
Yep.
has to go someplace. Correct. So it can't
Okay.
exist in an ether. The normal route is to have that money accumulate in a bank account until it is sizable enough to make another investment
The $4,500.
per year. Right.
Okay.
Would we agree that most of the time, whenever you get rental income or passive income of any sort, it normally fills up in a bank account until it's sizable enough to go do something with? Am I right? Or am I?
That's right. That's right.
I just,
Yep.
that's the way I do it personally. So it's got to fill up
Yep.
someplace, and then we'll go look to put it to work. And so we're just going to
Yep.
assume that instead of leaving that money in a bank account as it's waiting to be redeployed, we're going to put that money back into the policy because we are considering the policy as the bank. That's where we want money to flow to and from. So all we're doing, instead of having it hit a bank account, we're just having that money go directly back to the policy itself, where we pulled the money from.
Okay. And it pays that note. So now you owe $45,500 against a $50,000 policy, and you're
That's
still
correct,
getting.
And you're getting interest and dividends on the full cash value, even while the loan is outstanding, which is part of what we're going to go to, and describe to you how this is going to end up making sense. But what we did is we essentially said, let's just assume he holds this thing for 20 years. Okay. And we're going to keep it all the same. He's going to get $4,500 a year for 20 years, just to keep it simple. That means $4,500 times 20 years is $90,000. So essentially, his investment is going to produce for him in cash flow $90,000 of positive cash flow over 20 years. Now, that doesn't take into account, obviously, the ability for the property to appreciate or the amortization of the loan that he used to buy it.
But we're just talking, or getting the initial capital back.
Or just the value of the entire property over 20 years. You're exactly right. So you have appreciation, you have amortization. What I'm saying is you have all of that, whether you have a policy fund your deal or whether you just fund your deal. You got it? So obviously, what I wanted to focus on is the banking aspect of it, which is essentially $90,000 of cash flow that would have ran in through somebody's bank, because that was the cash flow is spitting out. So the policy, the investment property produced $90,000 of cash flow over that time. All we've really changed is where the money is coming from to fund the deal, and then where it's going to go to as it's producing passive income. Not a bank account, which is a zero-sum game. You get what you put in. We're trying to get off that track to where you get more than what you put in.
Yep.
And over the course of the time frame, the policy actually produced, so it received $90,000 from the investment property cash flow, but it actually produced $162,000 of cash value. 90,000 of it came from the cash flow itself. So what I'm trying to say is the property produced 90,000 of cash flow profit, but the cash value of the policy is 162,000. So we've actually made $71,000 in profit by financing the deal from the policy. This is really what we're after.
So the policy, the initial $50,000 still collects interest and dividends, even though you've borrowed that out. But is there an interest expense on the money you borrowed out?
Yeah, there is. So the policy loan will have a policy loan interest rate on it. That's right.
Okay.
So your policy, essentially how it works is you've got a cash value that is compounding and earning interest and dividends the entire time. And we collateralize that to receive a policy loan from the insurance company, which allows the
Okay.
policy cash value to continue compounding on the entire basis. And we're only going to pay interest on the amount owed at any given time. So if we're going to start plugging cash flow back into it, our loan balance is going to be decreasing. The collateral loan balance is going to be decreasing essentially down to zero at some point, whereas the entire value is going to be compounding the entire time. It's very similar to the world of real estate, where you use leverage to buy a property and you're compounding on the entire property. In other words, the appreciation of the property is on the entire amount of the property, though you may have only put in a very small portion of capital to receive the compounding on the entire portion of the property. It's actually being able to do that, but with money, not with property. So we're able to have the money continue to compound the entire time while we're quote unquote amortizing it out. But the good news is that you're actually in control of the amortization schedule. So in other words, the insurance company offers you this collateralized policy loan on 100% of your cash value at all times, no question asked, no application. You just literally say, I want my money, and they send it to you in a check. And then that's it. There's no approval. It's not like opening a home equity line of credit against an asset, which would be a similar style transaction, but
well, then the other gentleman we had on here talked about the you still have the death benefit the whole time too. So
100%.
So you still have the death payout if something, God forbid, were to happen. You're still holding that kind of off to the side where, hey,
it's
this
like the
is
cherry on the top. I mean, we hope you don't
better.
die anytime soon. The insurance company hopes you don't die anytime soon, because the best way to beat the crap out of the insurance company is to die early. You could put in $100,000 and they write a $2 million check because you got into a car accident. I mean, So they hope you don't die.
That's right.
You hope you don't die. But it's nice to know that it's there. But you're right. We won't get into that very much.
They're in the professional gambling business.
They really are. They're gambling that you're going to
gambling on your life.
Exactly right.
That's right.
You're not going to die anytime soon.
So, hi, this is Casey Brown, host of the Cash Flow Pro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making Cash Flow Pro part of your day. Now, back to the show. So somebody comes to you and buys now in the insurance business, let's say that I have $50,000. What type of a whole life insurance policy, what amount of a whole life insurance policy would I be able to secure with a $50,000 investment?
I would tell you right off the bat, Casey, that we don't even really bring up the death benefit much. And what I mean by that is the average insurance person would go meet with them, just buying life insurance, and they would take a look at your finances. They'd say how much money you earn and what's your net worth and so forth. And they're like, we would recommend purchasing X amount of death benefit based on your ability to earn income and worth. And
based on your ability or your needs.
Exactly.
Your needs.
You need this amount because
your
your family would suffer without you. And so you need to replace your income with a death benefit. And here's how much death benefit would be needed to replace your amount of income. That is the typical life insurance discussion. But that's solving for something we're not even trying to solve for. That's essentially what we're trying to bring up. That we're solving only for the banking. The death benefit is a side effect. It's not a priority goal wise. So we don't even bring up a life insurance discussion with somebody, essentially. So what that would mean is, Casey, we would build a policy based on how much money you would like to put in, how often you'd like to put it in, and we would build those deposits to produce the highest amount of cash value that we can have them produce, and the least amount of death benefit that we can have them produce.
Okay. And then you borrow the money back out. once it gets to a level like, so let's say you want to put $500 a month into this policy. Then if it gets up to you do that for 100 months, 2 years basically, and you have $50,000 in your policy. Then you borrow that out, use that as a down payment, or use that to buy whatever the investment
Mm-hmm.
vehicle is. Then you pay interest on that 50 that you borrowed from your policy, but you're paying that interest to your policy or to the company.
It's essentially to the company. They're the ones using that interest to allow your policy to continue to compound. I wouldn't try to overcomplicate it too. It's very similar to kind of like a HELOC style, which maybe more people are
Yeah.
understand, where you have a house that's worth so much, you can leverage against it. The house continues doing exactly what the house was going to do, and we pay the bank back with
Yeah.
interest. I mean, that's essentially
Okay.
exactly what a policy does.
We're making payments to insurance company and mortgage company basically on
That's
income
right.
producing asset. Okay. Income producing asset yields, let's just say 10% or what,
Mm-hmm.
or let's use your $9,000 figure, or 9%, $4,500 figure.
Right.
So then you take that $4,500 and you pay the policy down
The loan
as you. So
balance.
it's
Yep.
just, so we're building a circle. We're building a circle
That's
here.
right.
You make, are the interest payments on the policy? I'm trying to wrap my mind around the interest on the 50,000 we're paying to the company, as, and then we're paying the principal down with the income from the asset. Okay. So over 20 years, then you just continue, or once that initial loan is paid off, then you can continue putting that $4,500 towards increasing your policy's value.
Yeah, and yeah, that's a good point. Yeah. So in this scenario, what's happening is we're right. You don't exactly. We're assuming you're not contributing loan interest from a different source in our little hypothetical scenario. In other words, the
Okay.
only amount of money we're
Okay.
contributing is the amount of rental or passive income that the investment itself is producing. We're just choosing to roll that
Okay.
into the policy.
So
A good portion of that.
we're not making monthly interest payments on, the $50,000 loan that we took out of our policy.
That's essentially correct. In our example, we're just saying we're going to roll this money back in. It is true though that it is ideal to use policies to invest in things that do produce higher amounts of yield than the loan rate on the
Okay.
policy itself. That's right. So the
Yeah,
loan
yeah,
rate
yeah.
would be
Yeah,
somewhere around
yeah.
four to five
I
percent or
think
something
that's
like that.
the yeah, I think that's the goal everywhere.
Like in other words, a
I think
policy
that's what we're
exactly
all trying to
right. So
do.
the policy itself is going to produce a rate of return inside the cash values of 4 to 5% by itself. The loan rate is also
Okay.
typically in that 4 to 5% range to borrow against the
Gotcha.
cash values. So there's a couple things. You normally wouldn't want to invest in something that's going to produce less than 4 to 5% and to begin with, and take risk when you can get a risk-free 4 to 5% in a policy. Would there'd be no reason. So
That's
we
right.
are assuming that people are putting money to work in places that are going to at least they would hope. Obviously, investments can go south,
Yeah,
but they would hope
that's
produce
right.
more than 4 to 5%. So then all of the
Yep.
income that's produced can roll back into the policy. We could also change it too, Casey, and say you don't have to only invest in cash flow producing assets, because you could
Sure.
put $50,000 and just let the interest accrue inside the policy. You don't actually have to pay it. That's what's
Yep.
it can just add to the loan balance, and we can let it accrue in the policy. And then 5 years down the
Well,
road, when the syndication or when the property is sold, and we based it on appreciation as opposed to cash flow, then we could just plug the balance of the policy back in. The money's still compounded the entire time, and we're ready to rock and roll in both scenarios. So I wouldn't say it's very
what
strict.
what percentage, you talking about the original purchase of the policy, what percentage interest does that typically pay? And I know that fluctuates, but are we, because I think so many people, and immediately I know where my mind goes. And like I said, I'm a pretty average guy, so I feel like my mind goes where a lot of people's mind goes, and that is to the interest that is accumulated. So if I buy a $50,000 policy and didn't do anything, my mind automatically goes to the 1,000th of a% that a savings account pays, and that's virtually, you might as well just take your money and go set it on fire. So and use it to heat your house, because heating oil is so expensive or whatever
Yeah.
the case is. But what is the percentage that pays?
So the asset itself, that's a good point. So this is what I was trying to bring up a lot. The asset itself has value. The system of infinite banking is how to deploy that asset. So uh, obviously the policy grows by significantly more than the bank account. That's why we're really using it as the bank, right? So
Sure,
most policies
sure.
grow somewhere in the 3.5 to 4.5% range, somewhere in
Okay,
that
okay.
range. And
So certainly better than a CD, or better than a savings account, or really better than just a lot of other things
by itself,
that you
it's
can
not
invest
bad.
in.
Yeah, within the risk-free world, right? So in other words, we're
But
speaking of a policy is
yeah,
guaranteed to grow. There's absolutely no volatility or market risk involved inside of a life insurance policy. It's contractually guaranteed to grow every single year. So there's value in that. We're happy with
okay.
that. But really what we're after is not just that. It's really based on, okay, if, like in my example, I was able to make an investment that produced $90,000 of cash flow, but I was able to combine my banking with my investments, so where I actually end up with 161,000. So that
Yeah,
the
yeah, at the end of
property
the day.
produces 90,000, but I have 161,000 of actual cash ready to redeploy based
Yeah,
on the ability of my cash values to continue compounding on the entire amount over any length of time you're talking about, even while it's leveraged out. So I'm getting that
yeah,
amortization appreciation style effect that we get in the real estate world,
yep.
in just the money world is what we like to call it. The
That's
bank
right.
is the money world. So we get that same effect that occurs in the real estate world. We get it on our money as well. So this is why we say it essentially complements any deal. Like we can make more money on any sort of investment or anything we're doing financially by changing how we finance it. We can make, in this example,
Because
we
you're
almost made as
you're
much
essentially
financing
stacking.
it as we did in
Yeah,
the asset itself. So we're
yep.
trying to. You'll hear a lot of us infinite bankers that have drank all the Kool Aid. You'll hear us say things like having your money do multiple jobs, and that actually is the
Yep,
truth. Honestly, I mean, essentially, we're saying your money can be invested in this property while it's also compounding in this policy, while it's also producing this death benefit for your family that you wouldn't have if you
yep,
just built up cash to begin with, and and I don't want to get too deep into taxes, but the interest you pay on your policy loan
yep.
is a deduction to you if you use it for an investment, just like if you borrowed the money from anybody
As
to
borrow money from the bank or
yeah.
whatever. Yeah,
And
I'll
we're
be
borrowing
down.
money from a life insurance company using our money as collateral. So
Yep,
just like if we borrowed money from any source to make an investment, the interest is deductible. So
sure.
we also can, not only did we make an extra $71,000 of profit, but we also got to increase our overall tax deductions over that time. And
So
so
yeah, so the fringe benefits or whatever just
yeah,
continue to
there's
pile
fringe
on.
benefits
It's
involved, but it's obviously not the main one. Like we would do it without the tax benefits.
Yep,
But yeah, it's just nice to take advantage of the tax benefit, the death benefit, and all these other little fringe benefits that are nice, just that are going to be
sure,
involved in it.
sure.
But at the end of the day, we're trying to figure out a way that we can make money even when it's not invested. That's
Yep,
essentially what we're trying to do in the infinite banking. That's what we're trying to solve. That's why I mentioned scale as well, because I think almost everybody believes in having some sort of emergency fund available. Most of the
oh
time, banks
yeah,
have a monopoly on emergency funds, and so
yep,
the average person will have, especially if they're relatively successful, $50,000 to $100,000 is not uncommon for people to just keep kind of on the sidelines as the rainy day fund.
yep. It's a
And
pad. Yep,
yeah, just as a pad. They're not even looking to invest it. They're not. It
yeah,
just helps us sleep better at night, and that's absolutely true. But the opportunity cost of having that money sit there for 30, 40 years is actually
yep.
mind blowing.
The
I mean, it's
inflationary.
hundreds of thousands. I'm not even talking about inflation. I'm just saying like what you could get if you transitioned out of that into something that actually produced profit.
That's
Um,
right. Or income. Yep,
I mean, I can run the
that's
scenario
right.
right now, but I want
Well,
to say it's about 150 for every 50 grand over a lifetime in emergency fund. It's about 150 to 200,000. If all you did was move that to the infinite, solve the need for an emergency fund with liquid cash that's guaranteed to grow with no risk inside of a policy, which is really what you want for an emergency fund. So that's the small scale. The larger scale would be doing that and building up capital that you plan on
sure.
deploying. That would be
Yep.
a larger scale infinite banking maneuver the tiny small scale is just moving over cash that's not doing anything. And then there's the other scale
That's
of
right.
we're going to move over large amounts of money in order to produce deployable cash that we actually plan on using to make investments or something of that nature. Yeah.
Well, awesome, Nate. You finally, I think hopefully we've cracked the code on getting this because I think we finally putting it into the circle form really is going to let it resonate with the listeners as far as where they put it in, what happens to it as it goes around, and how it comes back forward. So first of all, before we jump off here, I have two quick questions, and we've gone a little bit over today, so I want to maybe get some decently quick answers from you. But
Okay.
what is the best book that you've read recently?
Oh man, I would say
Or it doesn't have to be recently. What's the
recently
best book you've ever read?
Well, I would recommend, obviously being an infinite banking guy, that people read the book that started this whole thing. So that's the book that has impacted my financial life more than any other book. That's Becoming Your Own Banker. The book's titled Becoming Your Own Banker by R. Nelson Nash. That would be the book that started this all. It had the greatest impact on my life. Obviously, it's what I do professionally. It had such a profound impact on my life. And
Awesome.
that would be what I would focus on. Absolutely.
Awesome. Now, where have you taken the best trip of your life, or where do you hope to take the best trip of your life?
Oh man, I would say that the best, the most relaxing best trip is heading to Kauai. I love the island of Kauai in Hawaii. It's known as the Garden Island. It's a beautiful place, and it's, as far as Hawaii goes, it depends on what you want. It's the least touristy place to go in Hawaii. It's the least touristy island.
Sure.
So if you're just going to relax and hang at the beach and and stay in the United States, which, I've traveled to other countries. I like the U.S. I want the best the U.S. has to offer. And, while going to Mexico and going to some other tropical places is nice.
Sure.
I think Hawaii is probably the best that the U.S. has to offer with that type of vibe, and so I enjoy it.
Awesome. Good deal. And how can the listeners reach out to you if they want to maybe even get more information or pick your brain on infinite banking, or maybe even make an investment or do some business with you? How can the listeners reach out to you?
Yeah, well, they're free to email me. My email is nate@livingwealth.com. Nate, Nate at livingwealth.com. They can shoot me an email. I'm happy. I answer emails all day. But we do have obviously a website, livingwealth.com. On there, you can get a free ebook that talks about this topic if you'd like. And we also have a free beginner's course, which actually goes into a bit more depth than the ebook. Both of them free. And so that would be really the next step for most people if they want to get in touch with us, is you can email me directly, ask some questions. But either way, I would say the next step probably would be to get your hand on a resource and take a bit of a deeper dive. So we have two free options. But then also Nelson Nash's book, you can buy it's like $20, $25, something like that on Amazon.
Sure.
That would also be a great next step.
Well, Nate, thank you so much for your time. I hope the listeners have got some value, and it's hopefully we filled in some of the gaps in the infinite banking concept. So thank you so much, Nate. I hope everybody has a wonderful rest of the day, and thanks for listening. Cashflow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.